You're listening to New Retirement Radio, brought to you by the team at Prout Financial Design.
Hello, I'm your host, Certified Financial Planner, Dennis Prout.
I'm Heidi Cartwright, Financial Advisor and RICP.
Advisors associated with Prout Financial Design may be either 1. Registered representatives with and securities offered through LPL Financial, member FINRA SIPC, and investment advisor representatives of Integrated Partners, a registered investment advisor, or 2. Solely investment advisor representatives of Integrated Partners, a registered investment advisor and not affiliated with LPL Financial. Investment advice offered through Integrated Partners, a registered investment advisor. Integrated Partners and Prout Financial Design are separate entities from LPL Financial. Dennis Prout and Nathan Prout are solely investment advisor representatives of Integrated Partners and are not affiliated with LPL Financial. The opinions voiced in this show program are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriately qualified professional before making a decision.
WTCM News Talk 580. Good morning, everybody. It's time for New Retirement Radio with Prout Financial Design in Traverse City, Michigan, starring Mr. Dennis Prout. Good morning, sir.
Ron Jolly, and it is that voice you hear. Ron Jolly is with us. We had a client who doesn't always listen to the show every week say, we really miss Ron. And I said, you know what? Ron's with us on the show. You're kidding. What? He joined you guys? Oh, yes, he did.
What?
Oh, yeah. Well, it's great to have you with us, Ron, and see you riding that bicycle of the soundboard ahead of you.
That's the controls.
The controls, you betcha. Well, so if you have a question, by the way, as Ron mentioned, I am Dennis Prout. We are here to answer your retirement questions. Questions related to retirement, taxes, strategy. And it's a complex world out there, and we are here to try to answer those. And our phone number via, text you could do, or voice.
Either one. One number, two options. 231-947-0023. 231-947-0023. Text us or call us.
Now, you sound a bit echoey.
Yeah,
so
I don't
there's
know.
an echo chamber going on there.
I don't know what's up with that.
Oh.
Check, 1 2 1 2 1 2.
That's better.
That's better.
Yeah.
Huh.
Yes, indeed.
Well,
whatever that
okay.
was, whatever change we did. So there, this. You're out there. There is change afoot, as they say. The game is afoot. What do they say in Sherlock Holmes?
The game is afoot.
The game
right?
is afoot. So the game is afoot, baby. It is amazing what's happening out there. Before we get into that, Nathan Prout joins us, our own managing director. Hey there, good morning, sir.
Good morning. It's great to be here. Yeah. It's great to be here, yeah. It's a nice day, yeah. It's nice to have a nice day, yeah.
It is. It is summertime, and the living is easy. We'll see if we can hear a few dulcet notes on that one. And then Beth Shar, sitting back there behind the screen, behind the window.
Yes.
Over there, Beth Shar, our own marketing director. Good morning.
Good morning. It's great to be here, and I do love this view. It's great. I get to see everybody, feel a little bit more in it, to win it, if you will.
That's right. You get a good. You're overseeing us.
Yeah.
Literally, you're overlooking us.
Mm-hmm.
Yes.
Elevated.
So I think it's a better place. All want to be in a better place, don't we, Ron?
We do want to be in a better place.
Yep. So today, given what's going on in the dynamism of this world in which we live, by the way, NVIDIA earnings, they just announced them, blew away all expectations. In fact, they blew away the whisper number, that what they're hoping they might get to. It was $80 billion for the quarter. $80 billion. Their earnings are such that their PE ratio is now at 30.
What's
the S&P PE ratio is the price of a company divided by its earnings. Its most recent quarterly earnings, multiplied by 4. So they given that earnings. I heard this posed a week or two ago. I think it was on Maria Bartiromo's program. Anyway, that said, would you rather own the S&P 500? Now, there are different risks between these two holdings. I fully recognize that. Would you rather own the S&P growing at 25% or so in earnings, companies that trade on the S&P 500 companies, or NVIDIA that's growing at about 80 times in a given year? Which would you rather own? Mm-hmm.
I'll go S&P.
You would. You like more conservative, 25 versus 80, huh?
And NVIDIA's just had that incredible growth over the last year and a half. So it's got to, I don't know what I'm talking about. I'm just saying maybe it's got to level off at some time, right?
Did you think it was a trick question, right? You wanted to be.
Ron, and you give the perfect foil to that question.
That's why I'm here.
Foil to it. You betcha. So some would say I like the relative safety of being on 500 companies versus being on one. But the point made was, given that earnings rise, would you want to risk a small portion, perhaps, of your capital to own such a growth company as NVIDIA, given what's happening out there? I think that might be a question. Now, am I proposing people own NVIDIA? No. I'm just saying that growth that they're experiencing is eye-opening, and given what they're trading at, their price versus their earnings, relative conservative number, because as you say, Ron, the market is a bit concerned about the word I want is not quite appearing to my mind. They're a bit concerned about the focus of the company and the non-diversification of its product line. That's what I wanted to say.
Remind us what NVIDIA does again. They make chips for AI, or
they design chips for that are used in AI, and they have the fastest chips in the world. And China has been drooling over their chips, and they reluctantly release them to China. And it's a constant negotiation tool because the world needs those chips and the speed that they allow, given the computing power needed to continue to drive the whole AI greased lightning ride that we're on, if you will. Okay? Yeah, it's significant. So, recognizing the times, pay attention. I just wrote some notes right off the top of my head this morning before the show. This wave is serious, and Beth is going to bolster our argument with the earnings reports that we've been seeing by the G7, not the G7, the top 7 companies.
Magnificent 7.
The Mag 7, yeah. This wave is serious. Number 2, recognizing the times. Who owns Google and Apple? Surprise, Berkshire Hathaway. They just started buying into Google here this most recent quarter, rather. Next, the application of knowledge is key. As you gain knowledge about this, recognizing, wow, what is going on here? This is just amazing to watch. Now, is every company going to profit equally? Obviously not. But that application of knowledge could be key. Next, taxes are the lowest they've ever been. The lowest. Our bottom tax rate is 10%. Now, it's not a lot of earnings that we're taxed at, that individuals rather are taxed at 10%, but 12% is a relatively wide bracket, all the way up to over $100,000 in taxable income. 12%. Well, in the 70s, the top tax rate, I believe, was, give or take, around 75%.
Wasn't it like 90% for the top earners?
It was in the 40s, I believe. Yeah, when we were paying. We've got a war going on out there. So the taxes are the lowest ever. The economy is running hot. It is running relatively hot in spite of the inflation ticking up. Now, the news feed will always negativize, if you will, the information out there. Now, because, and Nathan was mentioning this, because NVIDIA came, what, 0.1% or 0.2% lower on their profit margin. It wasn't 75.1, it was 74.9 profit margin. I mean, can you imagine owning a company that had a 75% profit margin? Not bad.
No.
Yeah. Amazing. So given that profit margin was, if you will, a skosh, however you say that word, just a touch below what they were expecting, just dynamic. So recognizing these times and perhaps considering for yourself, what percentage do I want in growth as a percentage of my portfolio? Growth type companies that are participating, that have wide moats, and can focus on and have that focus in this new technology, you might participate quite handsomely with that participation and improve your overall rate of return.
Is that, by the way, you were right, 1970s, the highest earners paid 70%.
And what did you say about me being right again?
I said... But
so I thought that was funny.
Is well, say NVIDIA specifically, or the stocks you're talking about, the companies you're talking about, are they considered conservative investments, or are they risky, or, I mean...
Neither. I would give them in between, Ron, because the amount of profit that they're generating is that significant. They actually have money in the bank, if you will, so they have cash. So they're not that far on the edge in terms of growth. That we're not in the internet revolution that happened in the late 90s, where these companies no one had ever heard of, who is this? They're trying to develop this product, and they do an IPO. And speaking of SpaceX coming up here, and there is no earnings, and all of a sudden they're trading at $1 billion in market share, or market value rather. So these numbers are just stunning. What's being produced, but they're being produced by companies with earnings, thank you, and profits, same thing, but also cash in the bank, or cash in assets, if you will, current assets versus current liabilities. So recognizing where we're at is a key part of this article that I have from Fidelity, the new diversification. So what does that mean? It means that you may want to spread your risk further to take advantage of what Fidelity is saying is happening, amongst other things. Number one, high levels of government debt may limit policymakers' ability to respond to future crises. Our debt is basically right now at 100% or so of our GDP. Never seen before. Never. I don't think even in World War II, when we were paying for a war out there, as we previously quoted. Next, in this environment, investors may want to consider diversifying their diversifiers, diversifying beyond the typical. I've always wanted to be a bit different, darling. Maybe we should speak to the Prouts. Well. Anyway, adding investments to help manage inflation and future episodes of volatility. Next, small allocations to Treasury inflation-protected securities, or TIPS, which we've been using for a few years now. Short-term TIPS to further control the volatility in those. Those types of investments will perform with any inflation numbers. So what is that? I mean, you can invest in these through using well-known mutual fund and or ETF providers at the drop of a hat within your own IRA or foundation or charitable account or whatever.
What are TIPS again?
Treasury Inflation Protection Securities. So they are issued by the federal government. They are guaranteed as to a minimum interest rate, but they also have a kicker, if you will, that allows them to participate with inflation. So your returns are based on the most recent quarterly inflation rate. Could be a good way to diversify, is what this article is saying, and what we say. Because it's a great way, potentially, we say the word potential, to participate with inflation in a very conservative manner and further diversification to your accounts for that portion of your portfolio that you want to keep relatively conservative.
Yeah, and being able to participate with inflation is the kicker there. Really especially if you believe inflation might be running a little hot right now. Obviously, we're seeing more recent reports that the gas prices are starting to obviously play the largest part of that right now. Mm-hmm. So, maybe depending on a little bit how much longer the Iran conflict goes on for, until oil prices start to stabilize again. But
yeah, a part of it. Gas prices, energy prices, home prices, all the rest, all contribute to inflation and the inflation number. Diversification is hardly a novel concept, this article says. For the past decade, diversification has started to look like an expensive and perhaps even unnecessary form of insurance. U.S. stocks delivered a commanding 15.3% annualized return over the last 10 years. 15% per year for the last 10 years. Just stunning numbers. Now they're also referencing non-U.S. stocks or international stocks trailed by 6 percentage points per year on average, that rate of return. And we talked about this. What they mentioned in this article is the efficiency and importance of considering international because they've underperformed the United States stock market. Such a wide performance discrepancy might lull investors into overlooking the insurance-like value of diversification, but don't be lulled into complacency. There are some assets that look like a good value. International stocks, well chosen by good money managers, could well be a great diversification tool, even at 5 to 10% of the portfolio. Does our portfolio contain those kinds of companies that can allow us to diversify or be diversified in that manner, given their underperformance? Now, for sure, last year, international stocks had a 29% average rate of return.
What would be like a recognizable international stock?
Bristol Myers.
Yeah.
Mercedes-Benz.
Okay.
Mm-hmm. Mm-hmm. Yep. Bristol Myers Squibb. Whatever that means. Like diversification, concern over U.S. government debt is hardly anything new. Federal debt as a percentage of GDP has been rising since the 70s. The pressures of U.S. indebtedness have been escalating in recent years. Now, what's going on is little U.S. government spending is discretionary. 60% of it is mandatory. Mandatory. It's already baked in, if you will. 14% is interest. 14% of what we spend is interest.
Jeez.
12% is defense. So 60 and 14 is 74, and 12 is 86. The balance of 14% is non-defense discretionary. 14% of our spending is discretionary.
So even if you cut a lot of these wasteful programs, like I think Doge tried to do, go through the various cabinets, departments, you're still only working within that little 14% range. Everything, what 86% is already accounted for.
Well, if they're cutting waste within discretionary spending, that could also be a way to cut spending, for sure. Okay. To be clear.
By the way, your debt to GDP ratio in 1945 was 114%. It peaked at the end of World War II.
Okay, great.
Right now, it's at about 100% right now.
About 100%.
Yeah.
All right. So we're playing with fire, as it were, because are we at war? What would people say about that?
That's a good question, because I'm not hearing about any attacks or bombings or anything, right?
Wow.
Depends on your news source.
I know.
Yeah, yes. Probably another question for another day. Pressure on the Fed to keep interest rates low. High indebtedness might increase volatility. The Fed's mandate is to keep inflation low and stable. Well, good luck with that. And we've been hearing that they may have to raise interest rates. because of inflation. And it's where the market is. So given that the market is charging more for money, they may have to follow suit. That's what they usually have to do anyway. What? No, they just set it on themselves, on their own. No, they do not. Limiting the ability to respond to future crises, federal government policy provides key tools that can smooth out the economy's bumps. Well, if they're at 100% right now, they may have less capability to do that. Higher long-term inflation. Less dramatic is the possibility that high debt and deficits could set the stage for a long-term period of higher inflation because they're competing for money. They're competing for it. So, yes, that can make a difference. Now, next, what's interesting is, I think, the challenge and opportunity for investors diversifying their diversifiers by adding certain investments that perform differently than traditional stocks and bonds. That's, again, international. That's Treasury inflation protection securities. That's alternative investments, real assets, commodities, that sort of thing, that respond differently, but could also help improve your rates of return. Now, are you trying to get giantly ahead of the markets? No. But if you can help protect yourself, who wouldn't want to try to do that and also improve profits into the future? Because we all have an ever greater responsibility to grow our own portfolios. As we saw yesterday in that class that we did, it was full, and we were talking about cybersecurity. Because, and I mentioned to the attendees that the part of this is riding with the insurance policies that you want. Having insurance or making certain that you understand or increase your understanding about the threats simply as a relationship to the amount of assets that we have. On a global stage, the United States citizen has a significantly greater amount and number of assets. Given that reality, we have to play defense sometimes too. And we have to arm ourselves and have insurance. Part of that is being aware of how we can be attacked cyber-wise, if you will.
For individuals, can you have insurance for cyber attacks? Like
I don't know if an
it
individual
seems like there
can.
would be a great product for an insurance company, but
Yeah, I know you can do some cyber crime policies, but you have to get into pretty specific coverages. It might not, depending on your situation, might not help you that much.
Yeah, so anyway, just thinking about this more deeply, what are the areas to think about, and why would I want to think about this? Is because of the increasing responsibility of all of us, because of the amount and variety of assets that we own as a population. Next, real assets are a type of alternative investment. They can include commercial and residential real estate, infrastructure, perhaps even commodities. Real estate investment trusts, those kinds of investments can be a smart alternative investment. So owning these kinds of investments or being more aware, you don't have to bet the farm on those kinds of things. Lastly, they mentioned commodity-related investments. That could mean everything from precious metals, gold, silver, platinum, and energy types of investments, or agricultural resources. It just depends on what your advisor can avail you of, as well as what you already own in your own portfolio, recognizing that the power of what you may have already accumulated, using that as even a stepping stone to the future too. Now, another part of this is, as always, keeping track of the estate planning. I mean, there's a lot to do. It's almost a part-time job. What I see out there in the field of retirement planning, individuals, people, if you will, are spending more and more time keeping track of this, monitoring, following, than I've seen in my lifetime.
So does your office get a lot of calls from people that are retired and have the time and follow what you're talking about and call and say, I want to make a change, or what do you think about this? Do you get a lot of...
We don't get a lot of those kind of calls, but we have those conversations when they come in to sit down and review their portfolios. That is an active conversation because the statements themselves, as you know, present where the diversification is, where the allocations are. What should we change? What could we do better? Those are the kind of conversations that all of us want to have. It's not rocket science, but that's key today because of the opportunity and because of the risk. Now, what are those who have more experience than us? What are they doing? Many times that can be a key indicator. As I mentioned, Berkshire Hathaway purchasing Google. It's just interesting that they're buying a stock with a PE ratio above 10. That used to be one of their cries, of
a screener, if you will.
If you will, of, we're only going to buy a stock that, they bought Apple when it had a PE ratio of under 10. Isn't that amazing?
Didn't they sell a lot of the Apple stock last year? Yeah.
But they've stopped selling for the reason Warren said, we sold too early. He actually admitted to a mistake. I admire that about him. So given that reality, again, what are these people doing with the smarts? Do I want to let others do that and or others play a more active role in this diversification and or reallocation in my portfolio? Those are the questions that, to me, that can make a difference in your portfolio, and recognizing among all the others, given how low tax rates are today, paying some tax as you go along on this can be a very good thing. Try not to avoid all tax. And what have we here? Have we a message?
We do, actually. We have a text. A couple of years after the Traverse City Costco opened, I thought about buying some shares. It had nearly doubled to just over $300 a share, so I didn't. Just look today, it's now over $1,000 a share. My wife says that's partly because she shops there.
What a great comment, because I think it was a couple of years ago, I had thought about buying some for each of our children and gifting them, 1 or 2 shares, I think, for Christmas. Maybe it was $500 a share. I don't remember what it was. And it blew away all the pricing that I had in my own mind. And so I said, forget it. And, there it is at $1,000 a share today.
I love my kids, but
yeah, not that much. I mean, what were we thinking? By the way, if you have a question, please feel free to text or, call.
Number's 231-947-0023, and got a message there, Beth?
We do. Want to know what stocks companies to invest in? Pay attention to what your teenagers or Gen Z kids are spending their money on and desiring to purchase. So that's a good, right? The youth control, what is it?
They're
the youth control the future.
Yeah, that's right. That sort of reminds me of Peter, what's his last name, used to manage a Fidelity Magellan fund. He used that as a key point in terms of investing in stocks. If you're going to own them, do you use the product? Obviously, do you like it? Is it a great product? Will you continue to use it again, or is it a place that you continue to shop at? Maybe it's Walmart. Talk about them blowing out earnings. Amazing. 25 or 26% earnings increase in their internet sales.
Ah, yes.
That's a huge number for Walmart. But, is it a product that you would enjoy? Years ago, he had mentioned Subaru. I mean, when they were just getting started back in the early 80s, as a great company to own, and man, they made a ton of money, with the Fidelity Magellan Fund back in the day. So some of those that is a key point. Do you like the product yourself? That can be a good marker for you. Okay. Nathan's next with our next report.
That's right. And we are in a historical year for a lot of reasons, but also a midterm election year. So, control, obviously, of Congress can shape the legislative agenda for the next 2 years. And what does that mean for you in your portfolio? Historically, the president's party usually loses seats during midterms. So average losses is about 27 House seats and 3 Senate seats. Now, of course, investors often price in the expected political shifts early in the year. And this article comes to us from Capital Group just a few days ago here as well. So what does the market typically do during midterm years? Well, I have the most surprising statement of the day for you.
Yes.
You ready?
Yes. Go for it.
Markets generally dislike uncertainty.
Wow.
I thought you were going to say it depends.
It depends.
Right. Yeah.
Stock returns tend to be weaker in the early months of midterm election years. Now, of course, there were some other forces that were playing on that earlier this year as well. But the S&P 500 average return during midterm years is 4.7%. And in non-midterm years, average of 9.5%.
Which do you like better?
Markets often rally shortly before and after Election Day. And of course, long-term investors historically benefited from staying invested. So timing the market even around Election Day is, of course, tricky.
It could be an opportunity, here's the rose-colored glasses approach, to reallocating, given that there's softness in some sector of the market. It's not priced at what you think and or what your advisor thinks could be the future potential for that company, especially this year, given that we're in an election year.
And of course, midterm election years historically show higher market volatility. Campaign rhetoric and policy uncertainty can create investor anxiety. So since 1970, midterm volatility averaged nearly 16%. But non-election years averaged about 13%.
Yeah, so what was the decline back in March of this year? I think it was at about 10%. And Warren Buffett referred to that as, that's piddling, that's nothing.
Right. He
What were you
still
thinking,
kept his
Pete
cash
Farrell?
reserves. He
Yeah, he
didn't come off the sidelines really
the
for that one.
470 billion or whatever the heck it is. It's
Yeah.
a big number.
But of course, watching what sectors are going to react to proposed policy changes. So, post-election market recovery, markets have historically rebounded after midterm elections. The average one-year return after midterm since 1950 is 15.4%.
These companies and the people who run them continually fight against the political realm of the day. They try to work with them to a certain degree, and you will see this consistently. They have other fish to fry. We all get that. But as Kevin Endress said to me this morning, I was talking to him about the property we have for sale over here. And I said, man, Kevin, how you doing with this wild world we're living in these days? He said, the world doesn't control me, Dennis. I said, I'm going to quote that on the radio.
He's 3 West Commercial Real Estate.
He is,
Yes.
indeed. And I just thought that was a great quote because there is truth in that. So what are we allowing the current political voices today, are we allowing them to control our activities, positive or negative? Are we skewing our decisions perhaps too far? Should I say this on the radio? To the right or to the left? Given where companies are, they're trying to create profits that are increasing in the future through their products or services.
Right. The market tends, of course, to always climb a wall of worry, as we have hit time and again on this radio show even this year.
Yes, sir.
But what you're also seeing, again, still, even with earnings yesterday from NVIDIA, these companies are beating all of their expectations, even with all of the headwinds going on right now about inflation, about the Iran conflict, about Russia and Ukraine, even about what China might try to do, who knows.
With Taiwan.
Exactly. But they're climbing that wall of worry. They're still beating expectations. They're still making a profit, and the market is still rewarding that, and they're appreciating in value.
Now, by the way, if you think that the United States isn't going to protect Taiwan, I think you all, or we all, have another thing coming, because when you take a look at what Taiwan Semiconductor is doing, that chip company, where does NVIDIA send all of their chip design and making capabilities to?
Yeah, not 70%, not 80%, but 100%.
Goes to Taiwan Semiconductor, because they have the only technology that allows them to.
It's advanced chip stacking.
Yes. Yeah. Whatever the heck that is. I mean, I read the term and I thought, there's no way I'm going to be able to repeat that. It was amazing. You know, I didn't realize that. Taiwan Semiconductor, TSM is the symbol of it. A great company owned internationally that has an international effect on the rest of the world. I think we're going to step up.
Is that publicly traded?
It is. Yeah. Absolutely.
So if China, if China invaded Taiwan and essentially took over, how would they control the chip company?
That is a great question.
I don't think China would have the only say in that hypothetical situation.
No. I think it would be a very interesting situation for sure. Yeah. We'll just put it that way. So while we think certain things may be under threat, you always have to consider it's always about the mighty dollar as well, and what services or things or products that company provides, as we mentioned. Yes, indeed.
That's right.
Any other points there, Nathan? Yes.
Yeah, and just as I was saying, other market drivers remain important, and this is also from the article. Inflation, interest rates, oil prices, tariffs, global conflicts, the normal. But political control versus investment returns. So long-term market performance has historically remained strong under unified government, even a split Congress, opposition-controlled Congress. So corporate earnings and economic fundamentals matter more over time than politics alone.
I think we could all have that repeated more than once
to
ourselves, right? I mean, I need it.
Investors should avoid emotional reactions tied to election headlines. So elections create short-term noise, but markets historically recover. And volatility can create opportunity for long-term investors. So how does this affect you? What should you do during the next sequence of market volatility? Because yes, it will happen. But what are you going to do? And hopefully, it's not sell everything.
That's right. Hopefully it might even be repositioning your portfolio to take advantage of what you can purchase at discounts. Conservative companies, perhaps, that are trading at a significant discount to their 3 or 4 week ago price level. All right, Beth, you got some interesting stats, I think.
Yeah, so we've been talking about NVIDIA, and NVIDIA posted Q1 revenue of just over $81 billion. That's up 85% year over year. And that's just incredible, as Dennis mentioned.
It's not a bad quarter. Yeah.
No, right? And that was above expectations.
Yeah, it was. That was above their whisper number, if you will. We mentioned it was $80 billion.
Yeah. Alphabet delivered a major earnings beat with EPS, which
also known as Google.
Yes. Yeah. Of $5.11. That's earnings per share.
Yeah, earnings per share. Yeah. $5.11. Yep.
Yeah. And then Microsoft reported solid numbers across the board, posting a 17.6% earnings growth as well. And Amazon, their revenue climbed 14% year over year. So all these are up.
All right, yes.
And let's see, Meta reported, 115 to $135 billion in AI infrastructure capital expenditures.
Yeah, the CapEx spending, which is what the markets are talking about. The amount of spending that these companies are doing is just eye-popping. Whether it's data centers or whatever. Jensen Huang with NVIDIA, the chairman, was talking in January with Maria Bartiromo about what the 5 major areas of investment are going on with these chips. And it was really interesting to hear. He said there are 5 sectors that are benefiting from this: the data centers, the real estate, all the support areas that are related to this chip build-out. Just stunning. I think he may have mentioned energy as well. But I hadn't looked at it from that perspective. I thought that was helpful.
There was an article the other day, I think in the Wall Street Journal, said there's a lot of resistance to data centers. They need them, but they're, townships are turning them down, and there's a lot of momentum in the press and elsewhere against data centers.
Yeah, did you see who primarily is helping drive that negativity?
I'm going to guess another country.
China. Surprise. China is driving, and that was another report in the Wall Street Journal I think I read yesterday or the day before, are driving significant negativity through their support of organizations that don't want the data centers to gin up, if you will, the negative response to data centers around these United States. Now, I'm not saying data centers are perfectly good, but it's interesting to note who's behind it and the significant dollars that are being generated to try to keep us, if you will, from advancing. Watch out.
Some of that resentment was, they said, not just the data center, but against AI in general.
Oh, yeah.
Yeah.
Anytime we have a new technology, here comes the car, the automobile, where horses were perfectly fine. Yeah. Whatever it might be. It sounds ridiculous to say, but there was a lot of resistance to the automobile in the day. How are we going to find roads that can support these things to travel?
All right, that's New Retirement Radio with Prout Financial Design in Traverse City. Dennis Prout, Nathan Prout, Beth Shire, all in the studio. Thank you.
Thank you, Ron.
Thank you.